Hello everyone, welcome to my channel Risk Analytica. Today my session is on non-cash expenses. Non-cash expenses, as the term implies, we can say no actual cash outflows or money is going out. So non-cash expenses are expenses recorded in the annual report or the financial statement of a company that do not involve actual cash outflows during the reporting period of the company. Reporting period is financial year 22, financial year 23, this way. Example of non-cash expenses are depreciation, amortization, impairment charges, stock-based compensation, and deferred tax expenses. Okay. Now, these expenses are very crucial for accurately reflecting a company's financial performance and its condition, and they are recognized to match expenses with the revenue. Okay. So in most of the annual report, you definitely observe that depreciation, amortization, and impairment expenses are considered while they calculate their net profit or net loss for the particular year. However, deferred tax expenses and stock-based expenses are, stock-based compensation are also part of non-cash expenses. And I'll cover all these types of non-cash expenses and their significance in the subsequent slides. Fine. Now, start with depreciation. Depreciation is a systematic allocation or systematic reduction of the value of fixed assets. When I say fixed assets which are tangible fixed asset like property, plant and equipment, machinery, furniture, leasehold, building or land, right of use asset, vehicle, other equipment against which we have to charge depreciation. So we can also say when a company buy an asset, it incurs a cash outflow. It means that they have spent money to acquire that asset. Now, company would use that asset to generate revenue over time. Now, to match the cost of the asset with the revenue, this cost will be spread out as an expenses over several period. Normal example, if you are using your vehicle like car or bike, the value will be depreciated year on year, right? So that reduction value you cannot see, but you can measure, you can understand. However, as per certain guidelines by IFRS and GAAP, a company has to follow certain approach to estimate the value of this depreciation. There are a couple of methods like straight line method, diminishing value method, which company follows to calculate their depreciation expenses. Suppose a company's value of asset they have purchased is 10,000 rupees, 10% rate of depreciation, then 1,000 will be charged. This 1,000 will be charged in the next 10 years so that the value of that asset, we can also say that after 10 years, the value of asset will become zero because 1,000 depreciation charges I am showing in my profit or loss account the next 10 years. Then the value will become zero, the asset value. Some company, they can also follow diminishing value method where exactly the book value considered when the depreciation is charged. Like this year is 10,000 is the value of asset, 1,000 is the depreciation, then the next year the balance will be 9,000. Then again 10% depreciation charges I will be imposed on that. Then 900 will be the value of depreciation. Similarly to the next year, 9,000 minus 900, 8,100 will be the book value of the asset. Again, on that I will charge 10% depreciation. Then the value of depreciation or the depreciation expenses will be 810. This way depreciation gets calculated. Now, the next thing, so all clear on that depreciation is only applicable for on the tangible fixed asset. And these are the few example of tangible fixed asset. Whereas in amortization, in the context of a manufacturing company whose principal activity is to manufacture, okay, they will charge amortization expenses. Amortization expenses is only applicable to the intangible assets. Example, goodwill, patent, copyright, software, trademark. Okay, these are the few example, trade secrets, licenses, and etc. Similar to depreciation, amortization again is the allocation of cost of an intangible asset. Okay. The cash outflow occurs when the intangible asset is initially acquired by the expenses is recognized over time through amortization. So year on year, I will be utilizing then the value of or the amortization charges I have to show in the profit or loss account. These two will be deducted and they are also considered as operating expenses. It is non-cash though, but it will be considered as a operating expenses and the same will be considered while calculating the operating profit. Now, as per IFRS International Accounting Standard 16, depreciation has to be charged against all the tangible fixed asset. International Accounting Standard 38 says that intangible asset, when you are utilizing, then you have to also charge amortization expenses. Similarly, for Global Accepted Accounting Principle, ASC, which stands for Accounting Standard Codification, amortization should be charged on intangible assets, and Accounting Standard Codification 360, where depreciation has to be charged against the tangible fixed asset. In my next session, I will cover other example of non-cash expenses like impairment charges, stock-based compensation, deferred expenses. I believe you have understood depreciation and amortization and its difference. Net depreciation is only applicable to the intangible, to the tangible fixed asset which we can touch, and the amortization expenses is applicable for the intangible fixed asset. That's it from today's session. Thank you everyone for your precious time. Take care. Bye.